Given the tumultuous shocks in the financial markets this year, along with a dark cloud of uncertainty that seemingly prevails, most have been pushed to take on the role of active traders. With persistent market dynamic shifts, macroeconomic pressures, and supply chain disruptions, investors have been forced to alter their portfolio structures and adjust their positions. For the average investor who is not a full-time market participant, this approach is highly unsustainable, and one that is wrought with many risks. This is where dividend investing comes in. Given the present market climate, dividend investing is increasingly being pushed as the way to go by seasoned investors and analysts alike. Not only do they ensure a return of value during a recessionary environment, but they also enable growth through dividend reinvestment at a time when the wider market is undergoing a sustained fall. Above all, investors can enter into ideal positions with attractive dividend stocks, and not lose sleep over their investments, all while making a strong passive income. The stocks discussed in this video are some of the best dividend payers, which can deliver top-notch passive income to their holders. The first stock on our list is the healthcare sector's giant conglomerate, Johnson & Johnson, which trades by the ticker J&J. There are a number of reasons why J&J is perhaps one of the best names to consider for any investor seeking a high-quality stream of passive income. From an investment standpoint, the healthcare sector is ideal, especially in terms of present recessionary fears, to stand firm against the oncoming storms. This is due to the inelastic nature of healthcare demand, and the ability to hand over inflationary burdens to the consumer. As one of the top names in its industry, as well as its massive size, Johnson & Johnson is the greatest pick in the market. Despite the company's extraordinary scale of operations, it managed to grow its annual revenue in January from $83 billion to $94 billion in a single year. The company is consistently acquiring top players in the game to further enhance its growth runway. This month, J&J announced a $16 billion acquisition deal of Abiomed, a company specializing in heart, kidney, and lung support technology. In terms of dividends, there is hardly a more reliable name than Johnson & Johnson. Although its yield stands at 2.64%, the company is pushing on its 68th year of consecutive annual dividend growth. With its rock-solid fundamentals and dominating market position, J&J is a must-have in anyone's passive income portfolio and ensures stable and consistent profitability. The second stock on our list is the American petroleum and crude oil distributor, Magellan Midstream Partners, which trades by the ticker MMP. Even though the stock is trading at its highest point of the year, it is still a remarkable buy, with its 8.12% dividend yield, and 21-year track record of consistent growth. In many ways, Magellan Midstream is a dream come true for its shareholders, with so many points of attraction to it. The company has a highly resilient business model, and has continuously expanded upon its distribution network in the United States, for the last 2 decades. Its product pipeline system spans over 15,700 kilometers, and consists of nearly 60 central terminals. Despite being in the energy sector, the nature of MMP's business makes it far more stable than that of energy producers. This is because it has structured itself as a landlord of gasoline and diesel fuel pipelines. 85% of its operating income is completely fee-based, making Magellan Midstream an extremely low-risk player. Furthermore, it is also a money-making machine, increasing its free cash flow in its most recent quarter from $65 million to $140 million, when excluding asset disposals. The company is a crown jewel for anyone seeking a passive income stock, considering its strong fundamentals and high yield. To add, its management has been aggressively engaged in share buyback programs for the last few years, with 3.5% of the outstanding share float being trimmed in the recent quarter alone. For these reasons, the stock is a screaming buy. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Number 3 on our list is Marine Products Corporation, which goes by the ticker MPX. The company is considered as a micro-cap entity, with an equity valuation of $370 million, and specializes in fiberglass powerboats which are used in sports, fishing and leisure. MPX is what financial gurus refer to as a cash cow. The company is completely debt-free, and reports low capital expenditure, whilst distributing the lion's share of its profits to shareholders as dividends. Throughout the last decade, the company has been steadily increasing its sales and financial position. In its most recent quarter, the company achieved an all-time high in quarterly revenue, despite selling a similar volume of units to the prior year. Revenue jumped 32% year-on-year, whereas net income saw a surge of a whopping 72%. This boost had come due to the company adjusting its pricing to match inflation of its production costs, leading to surging revenue. Moreover, the company's gross margin at 25% stands as being highly appealing. Over the years, the company has used these earnings to significantly strengthen its cash position, which in 2019 was $8 million, and is presently almost at $27 million. With such strong fundamentals, MPX is most generous in regard to its dividend payments. Its current and forward dividend yield stands at 4.31% and 5.02% respectively. The compound annual growth rate for these payments in the last 5 years amounts to 12.2%. The stock is a highly safe cash cow, given its business, and delivers stable income at very low risk. Next up we take a look at the $6.7 billion real estate investment trust, EastGroup Properties, also referred to as EGP. Any list of passive income investments is incomplete without mention of a solid REIT, and EGP stands as one of the most remarkable, for a number of reasons. For one, EastGroup focuses its business on urban warehouses and distribution centers, in the high-growth regions which include Texas, California, and Florida. The properties are located in some of the most strategically attractive points in the urban areas of the Sunbelt region, which hold extremely high barriers to entry, and cannot simply be replicated. As a result, EastGroup holds extremely high bargaining power with its clients. It is also worth mentioning that the REIT is actively engaged in expanding its pipeline to meet growing annual demand. In its most recent quarter, EGP reported for the first time in its history, an occupancy rate of over 99%, making it highly efficient as a business. The leasing contracts include rental hikes to reflect the inflationary state of real estate. In its most recent quarter, EGP saw its revenue jump year-on-year from $105 million to $126 million. The result was a funds from operations figure that grew by an impressive 13.3%. EGP offers a strong and well-cushioned dividend yielding at 3.25%. Considering its impressive business performance, and its high growth runway, the stock is currently at a bargain for any investor seeking a long-term passive income. The final stock on our list, and far from being the least, is the weight loss and nutrition company, Medifast Inc, which trades under the ticker, MED. The company is a fine quality business, valued at $1 billion, and one that caters to a global market valued at over $200 billion. In its most recent annual report, the company saw its revenue surge from $935 million to over $1.5 billion. Earnings per share during this period jumped from $9.14 to an impressive $13.89. Moreover, Medifast's cash holdings are at $70 million, while reporting zero debt. This gives it an incredible safety margin, which would allow it to engage in capital expenditure to support further growth. Despite this, however, the stock has shed almost half its price in the last year, owing to macroeconomic uncertainty among market participants. The result of this price fall is a very healthy dividend yield of over 6%, which is substantially higher than the personal service sector average yield of below 1.5%. Not only is this figure attractive in terms of its present yield, but also when factoring in the high growth it comes with. From 2015 to 2021, dividend payments have jumped up from 25 cents to an impressive $5.68. The stock gives its shareholders exposure to a fast-growing business with rewards proportionate to this growth, making it such a compelling buy. That's all from us in this video. We hope the insight we aimed to deliver has proven valuable to you, and would allow you to ensure your portfolio is well suited for maximum and sustainable dividends. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.